Thank you very much, David. It's great to be here and talking about our projects as well. So maybe just before I get into the main presentation, I always like to show this as a starting slide in my presentation deck, that there is a picture of the Kalakeara uranium asset. So Louts as a company owns two uranium projects, the Kalakeara project, which is located in Malawi, and our second project, which we just completed the acquisition of in November of last year, is the Letlhakane project located in Botswana. But that's Kalakeara for you there. That's a photo that was taken of the site a few years ago. Clearly shows to everyone, I believe, that all the infrastructure required to be able to start Kalakeara is in place, and therefore the capital and the time requirements for us to bring this asset back online are relatively short. Next slide, please. Obviously, won't spend a lot of time on this. This is just regarding our disclaimers and forward-looking statements. This is available on our website for people that would like to see it. So just from a corporate perspective, where is the company at the moment? Share price as of yesterday was around 33.5 cents. That's Australian cents, giving us a market cap of around $580 million. We have zero debt at this stage. As of the September quarter, we had approximately $15.9 million in the treasury, and that money is more than sufficient to see us through the work program I'm about to talk about. Well covered from a number of brokers at this stage as well. And if you just have a look at the pie chart there on the left-hand side there, you'll see a breakdown of the registry. Obviously, very significant ownership from our management team. We've been involved in the project since day one. A lot of retail in there, especially from the Australian side, but we're actually building up our global retail presence as well. ETFs, both the Global X and the Sprott ETF, are heavy investors in Louts, and we're expecting to see a re-rating from them as well in the next couple of weeks, which we think will be very, very positive for us. Institutions also starting to take a significant portion in our register moving forward as well. Next slide, please. So what is Louts about? Well, Louts is a company that is obviously focused on uranium production. We have the two assets that we are looking to bring back into production. Kalakeara is a low-cost, short-term project that's ready to go into production. Letlhakane is a much bigger project, has around 190 million pounds of uranium in its resources. We see this as being the long-term growth strategy for Louts moving forward. We know that Kalakeara has got about a 10-year life of mine based on the feasibility study that we put out in August of 2022. However, there is still some exploration upside associated with that, and we could see that life of mine being extended or alternatively the production being increased as well. But really the way we see the two companies or two projects working together is Kalakeara comes online, generates significant amounts of revenue based on the current spot price we're seeing out there at the moment. And the profits generated from Kalakeara would then be used to develop the Letlhakane project, which would come online some years after Kalakeara has started. As Guy has pointed out, and I'll talk a little bit about as well in the slides, very, very strong fundamentals at the moment. I mean, we're talking about the strongest uranium market in more than 15 years. I'm just looking at that price now. The slide's a little bit old. It's $105.50, I believe, today, looking at that price. Highest it's been since 2007. So very, very strong demand and a really issues with supply at the moment moving forward. Proven management team within Louts, a lot of African experience, a lot of project development experience, a lot of operation and execution experience within the team as well. So we're very, very confident about bringing these projects online at the right time. Next slide, please. So what are the two projects we've got? So as I mentioned, Kalakeara in Malawi, existing plant and infrastructure is all in very good condition. We require about $88 million, that's US million dollars required to be able to restart this asset. About a 15-month time frame as well required to refurbish this asset. The asset operated previously, so it's a past producer, operated between 2009 and 2014, produced about 11 million pounds of uranium during that period, and was shut down in 2014 effectively due to economic reasons. As Guy has hinted at, post the GFC and post Fukushima in 2011, the uranium price crashes, spot prices down into the low 20s. Kalakeara's operating costs were in the mid-30s. At that point in time, the project was no longer economic, and they put it into care and maintenance to effectively preserve the ore reserves. The project itself has a mining license and all the environmental permits in place. So again, this helps us ensure a short and sharp refurbishment and startup period associated with it as well. We can also access skilled local workforce. A lot of the previous operators from Kalakera are still in the area, still looking for jobs, looking to come back and restart this mine up with us. Letlhakane, as I mentioned, much bigger project, resource of around 190 million pounds of uranium. That's a very, very large resource. The project itself has its mining license in place. There is a historical feasibility study that was done back in 2016 that looked at around 2.4 million pounds per annum of production for about 18 years. We have a slightly different way of looking at that project, and I'll talk about that in a little bit when I talk about the future work programs. Also important to note, the Letlhakane project is located next to some really good infrastructure, right next to a sealed road, right next to a railway line, rail siding within the mining lease boundary. Substation exists within the mining lease boundary. Bore field for getting water also very, very close to where the mine is as well. So the project has got some really good infrastructure, which of course helps us in terms of not only developing the project, but also reducing the capital as we go about doing that as well. Next slide, please. So Guy's touched on this a little bit. And this is some of the numbers that he was talking about, or the graphs on the right-hand side over there. So again, this comes out of WNA. This is their September report. And I think what's interesting us from a producer side is really the graph on the bottom. So we start off looking at the top graph there. What is the power generation forecast from the WNA in their reference case? So this is not their low case, it's their reference case. It's not even their high case. Today, or in 2022, power consumption or power generation was around 366 gigawatt equivalent. Their forecast is for that to increase by about 3.6% per annum up until 2040, where we would see something in the order of 680 gigawatts of electricity generated during that period from the nuclear power stations. As I said, what's interesting for us is, well, where's the uranium going to come from to be able to feed those reactors? In 2022, reactor demand was around 169 million pounds of uranium, yet existing mine supply was only 130 million pounds. That gap was filled by material coming in from secondary sources, and secondary sources are predominantly inventory, but also underfeeding in the conversion process. But if we look forward into 2030 and specifically into 2040, the existing mine supply, so this is without any new mines coming on, this is the existing mine supply. In 2040, the reactor demand sits at around 335 million pounds per annum. And again, I'm talking about the reference case here, not even the high case. So in the reference case, 335 million pounds of uranium will be required by the reactors to be able to deliver that 680 gigawatts of electricity. Yet the existing mines today in 2040 will only be producing 65 million pounds of uranium. There is a huge amount of room for a large number of uranium mines to come online, and these mines have to come online to be able to deliver the uranium required by the reactors. And the only way that a large number of these mines can come online is if there's a continuing increase within the uranium price moving forward. Next slide, please. Just quickly touching on how we see the two projects moving forward. So as I discussed in one of my previous slides there, Kalakera is our first project that we want to bring online. The bottom graph there, the blue bars, show the production profile coming out of our feasibility study that we put out in August of 2022. As you can see there, a 10-year life of mine, very strong production potential in the first 7 years. That production potential drops off as we start to feed material from the stockpiles that have been produced as we're mining from the pit. But that's the opportunity where we see Letlhakane coming in. And in fact, based on the recent work that we've done, we could see Letlhakane coming in even earlier. So that green box there represents the potential for Letlhakane. And what we're trying to demonstrate to the market here is that Louts as a company will be in a position to be able to deliver uranium as a minimum of about 2.5 million pounds per annum, up to as much as maybe 4.5 or 5 million pounds per annum of uranium for the next 20 to 25 years. And that's the story that the utilities really, really like when we talk to them. So that really puts us in a strong position when we start to talk about offtake agreements with the various utilities moving forward. Next slide, please. So in terms of our value proposition, well, where do we compare against our peers? We've grouped our peers into two different groups over here, restarting mines such as Boss and Paladin with their projects in Namibia and in South Australia, and of course Peninsula as well, with their project that they're starting up in Wyoming as well. The average weighted valuation, if you talk about it, dollars per pound in the ground, for those companies sits at around $8.50. If you look at companies that are developing greenfield projects, you talk about the DPLOs, the Bannermans, the Aura Energies, the average price, or in terms of dollars per pound in the ground, sits around $2.10. Lotus, which has a combination of a restarting mine plus a new development site as well, based on its current valuation, is sitting around $2.10. We believe there is significant upside for our share price to increase such that we can become competitive with the other companies out there that are restarting assets moving forward. Next slide, please. Just some really basic economics as well I want to show on this slide. So assuming we had, and again, I'm pointing, this slide is probably a week old or something like that, where we had a spot price of around $91 per pound. If you look at our operating costs, Kalakia operates at around $30 per pound, an additional $8 per pound required to get to our all-in sustaining cost. That means we have a margin of around $53 per pound. On our 2.4 million pound per annum production rate, that equates to approximately $125 million EBITDA. And again, if you assume the $88 million of capex required to restart this asset, that means the project or the company has a payback period of less than 1 year moving forward. Those are really, really strong economics for any project, I believe, out there at the moment. Next slide, please. I just want to quickly touch on what are the next steps with the various projects. So as I've mentioned, Kalakia, we want to bring Kalakia online as soon as possible. We're looking at some financing opportunities, specifically looking to appoint some debt advisors. We're also having some conversations about potential equity raises at some point in the future as well. Uranium offtake, very big focus for us at the moment. Lots and lots of North American and European utilities are approaching us, asking us or expressing an interest in terms of signing some offtake agreements with us. We're busy having a look at a number of options around that as well. The mine development agreement is an important document for us to be able to start the mine up at Kalakia. We've been busy negotiating with the government of Malawi for that over a period of time. I've made some good progress in the last month or two, and are hopefully going to be able to announce some positive news on that in the next few months. Operational readiness, getting the plant ready to restart, looking at our feed program there to complete our detailed engineering design. Operational readiness in terms of recruitment, in terms of training potential as well, is also in the radar and things we're starting to have a look at. Next slide, please. What is Lotus focused on from a Letlhakane perspective? So as I mentioned, very, very large resource, 190 million pounds, but grade's probably a little bit low. 320 ppm is the average grade of that resource. But we know from the due diligence work that we did, there are some higher grade pods within that deposit. And we'll be looking at redoing that resource model to try and target these higher grade pods. We also know there's a potential there to do some beneficiation test work. We were very, very successful in Kalakia at using ore sorting to increase the average grade of our feed material. Can we use that same technology at Letlhakane, or are there other alternatives such as screening, cycloning, density, or gravity that we could use to try and increase that grade as well? So a combination of the upgrade to the resource model by focusing on the higher grade materials and also the beneficiation program, we're hoping will give us a much higher grade feed grade to a potential plant that we could then have a look at and go back and have a look at that flow sheet, see whether we couldn't duplicate something like the Kalakia circuit there as well. So that's what the focus is at the moment. In the future, we are looking at doing an infill drill program. It's important for us to be able to convert the inferred material at Letlhakane into measured and indicated so we can wrap an economic study around it. We're also proposing putting out a scoping study or a preliminary economic assessment on Letlhakane by the end of this year, really to demonstrate to the market how we see this project being developed. Next slide, please. That's the end of the slides, David. So thank you very much. Happy to take any questions.
Thanks, Keith. A great presentation. And it's probably going to be a question you get asked often and a question I ask Guy all the time. How hard is it to stay the course when you're picking a project up at a time when the market clearly isn't loving the sector, but you've taken a view and taken a taken a really calculated view on where you think things are going to go, but the equity markets probably weren't supporting you. No one was supporting you. You just had to back yourself and your management team in.
Yeah, I mean, so we picked up Kalakera, Lotus as a company picked up Kalakera in sort of March of 2020. So I think even at that point in time when we were doing the discussions with Paladin for the acquisition of Kalakera, we were very, very confident on the uranium market moving forward. And there was certainly a number of investors behind us and groups behind us that had the same sort of attitude and participated in that initial raise and also participated in subsequent raises that has allowed us to keep our dollars topped up in the treasury and allow us to do the program. So we've been very, very focused in terms of delivering a feasibility study that incorporates what we think were the optimization opportunities around Kalakera and being able to develop that and let the market develop itself. We knew it was coming. We just didn't know the exact timing of it. And I think from a timing perspective, it's actually been really good for us. We were able to pick up ACAP's assets last year. I think that was an absolute superb timing to be able to pick those up just prior to the market really ramping up on the back of the increases of the spot price.
And just touching from an in-country point of view, how keen do you think in country there is, or what level of support do you think and a keenness in countries is there to get this project up and running and seeing the benefits flowing back to the country and the local communities?
There is a very, very strong motivation, both from the local communities, but also from the government to get this project up and running as soon as possible. People who know Malawi will recognize it as unfortunately, a very poor country, struggles with foreign currency, is sitting in a very high inflation environment at the moment. They need revenue streams. They need income to be able to develop their economies. And the government stated about a year and a half ago or so that they had identified 3 different areas that they believed could be used to improve the economy. The one was agriculture, and Malawi's always had a very strong agricultural base, but unfortunately was very much focused on tobacco previously. They're shifting that across to more suitable crops at the moment that they believe they can sell internationally. They're looking at tourism. Malawi's got a really high potential from tourism with Lake Malawi there and a number of really good game parks available for tourism. But really the area that they've identified as being the main driver for their economy going forward is the mining industry. They recognize the mining industry is what could potentially add significant amounts of value to the country moving forward. And not only have you got Lotus and the Kalakera project, which is probably the first commercial scale project to come back online again, but there are a number of other companies there that have got world-class projects. And I think about Sovereign Metals and their rutile project. I think about Lindian Resources and their rare earths. I think about Makango and their rare earths project, NGX and graphite. So there is a huge swell in terms of opportunities for the government and for the communities in Malawi to be able to benefit from the mining industry.
Final question, and as I said, we will get you back on to have a more macro discussion with Guy and your fellow presenters. Mine life, as you said, you're looking at sort of a 10-year at the moment. Do you think there's an opportunity to, once you get in, expand that and grow that out further?
I think there is. I think there's a couple of things that we can do about it. So there's exploration potential. Now, within the mining lease area, there might be a little bit more uranium there, although I think we've covered most of the potential targets in that area pretty well. But what's really exciting for us is what's on our exploration tenements. So we own a further 4 exploration tenements outside of the mining lease. One of them is called Livingstonia, which has a small resource on it. It's about 4.5 million pounds of uranium at the moment. However, the drill program that we did 2 years ago has identified some further high-grade trends that we could follow up to try and grow that resource. And the tenement next to it is called Chilumba, where we did the first drill program ever on that tenement, again, about 2 years ago. We've hit uranium mineralization there. We think there's an opportunity to be able to develop that into a resource going forward. So we could certainly look at that as being the future feedstock for the plant. It's not that far away. It's 90 kilometers away from the existing mine. However, the material is very similar to Kalakera. The opportunity there, I think, is a satellite pit with a small crushing plant. The ore sorting technology that I spoke about for Kalakera should be applicable to that material. We produce a high-grade concentrate material that we can then truck up to site and put into the Calacara processing plant. There is one other growth opportunity as well that we're trying to get our heads around. Two different material types of Calacara. The Arcos unit, which is the sandstone and hosts most of the material. There's also a second material type called mudstone. Mudstone also carries uranium grades over there. We're limited in the current circuit of how much mudstone we can put into the circuit due to physical reasons, including rheology and viscosity. However, at the end of that 10-year life of mine, there is circa 10 million pounds of uranium still left in those mudstones. If we could modify the circuit or put a side leach circuit onto our process to treat that, that's an additional extension to our life of mine just by using that mudstone material.
Thanks, Keith. Great presentation. And as I said, we'll get you back on in a little bit to have a bit more of a conversation at that macro level, but clearly a well-defined plan, a management team ready to kick some goals into 2024 and beyond. Thanks for your time.
Excellent. Thanks very much, David.